Hey guys, for these uncertain times, I'm going to play this interview. I think it's a couple months old, but it's from one of the greatest economists that has ever lived, and Lacy Hunt. And I'm just going to listen to this.
Inflation is still high, it's coming down, but these basic necessity costs are hanging high. One of the features of the American economy is that we've been historically able to produce affordable cars and housing. They're not now.
It's not what's next, it's where.
I recently was able to piece together a global capacity utilization chart, and it indicates that factories are becoming increasingly idle across the globe. And this is an important concept because capacity utilization leads the unemployment rate, not only domestically but globally. And those that have written off the worst challenges to the labor market are behind us, I believe they will be wrong. There's still considerable challenges to the labor market. We just saw today that the difference between job prospects and the positive and negative is deteriorated very significantly back to where it was last summer. And the various rules that economists have developed between the unemployment rate and the inflation, although they have not yet signaled a recession, there is a very likelihood that in coming months they will. So the domestic and global economies face significant hurdles. And I believe that what we're going to see is that the inflation rate is coming down. In actuality, the inflation rate is considerably lower than it is being reported because there's overstatement in the critical housing components. In fact, I think that if you do a reasonable analysis of the error for the rent component, the shelter component, and adjust for it in line with the actual prices that we have, both for sales prices and rent, with the personal consumption expenditures deflator is probably running 1.8% year over year, and the CPI only 2.2. The inflation rate is not nearly as high as it seems. There was a recent outstanding analysis by one of the nation's leading housing experts, Barry Aviv, that presented this information. So I think that the road ahead of us is much more difficult than is generally believed.
Okay, road ahead of us is much more difficult than generally believed. So, what I hear from you, Lacy, is, hey folks, don't think the deflation dragon's been slain and, all the attention that's being given you're in a minority now, but definitely.
That's probably an understatement.
Yeah,
Great.
Relative to a lot of folks I've interviewed on this channel, they have obviously had to pick their side as an analyst, and a lot of folks are choosing to focus more on, as I said in the intro, economic growth.
What we were able.
Going into an office, working 50 hours a week, having that structure.
To determine is that CAPU is the main determinant of the supply costs, and as your capacity rises, it puts downward pressure on the cost curve for the stable items, and that is a very profound effect. In addition, we've continued to look at our detrended 4-year money growth rate, which is in negative territory. The detrended real money growth is also negative in the United States. You may say, well, why 4 years? Well, first of all, monetary policy lags are long and variable. Mm-hmm. And based upon the experience that we learned in 2020 and 2021, which was really exceptional, that when you have huge monetary explosions, such as we did, that the monetary policy lags are even longer. And so the monetary restraint is still in the system. And one of the important ways that it's still in the system is that even though the Fed cut the federal funds rate by 100 basis points, it didn't materially change the critical lending rates to consumers and small businesses. According to the Federation of Independent Business, the small loan rate is roughly 10%. Well, by the rule of 72, that means a small business, if it borrows $100,000 in 7 years, they're going to pay $100,000 in interest expense. And for the consumer credit cards and personal loans, even for prime borrowers, the compound effect will be shorter. And there's just no way that a small business can go for an investment that's going to cover that type of cost, and the consumer is not going to have sufficient income flows to repay a credit card debt that is compounding in about 3.5 years. So those rates are too high. And another element in the picture is that, by my measure, the Federal Reserve actually tightened monetary conditions further since September. And the critical variable that I'm looking at here is this modernized version of real dollar liquidity, world dollar liquidity, and it continued to contract. And if you go back and look at the relationship between WDL and the federal funds and the other lending rates, when the Fed was in an easing mode, those rates did come down, but real dollar liquidity was also growing rapidly. And that didn't happen in the fourth quarter. In fact, the quarterly average decline was greater than it was in the prior quarter. Historically, world dollar liquidity is growing at 10% per annum. We're now declining at 10% per annum. And when that happens, the Fed is not only draining liquidity domestically, but because we are the world's central bank, is having a similar effect globally, and monetary growth around the world is also contracting. And the essence of the facts, and the way I look at it, is that we and our four major countries are in a money liquidity squeeze. And that was not alleviated by the 100 basis point reduction. In fact, it worsened in my view.
Okay, and liquidity, regular viewers of this program know, super important.
And that I have the same general conclusion. The one point that I would emphasize is that as of the recent experience, the monetary policy lags are even longer when you have a huge explosion that you've never had before.
Right.
And you're coming off that peak. And so I would say we're dealing with a 4-year lag, but those are both now negative domestically and globally. I think it is important to put it in real terms and also to detrend for both the long-term average growth in money and also the long-term average growth in velocity. When detrended money growth is when real money growth before detrending is the same as your detrended long-term historic average, then the economy is in equilibrium. But when the real money growth on a 4-year basis is in negative territory, what that means that the economy, the Fed's policy is too tight. It's too tight, and it enhances a money liquidity drain. And I think that the way in which the Federal Reserve policy works really changed quite a bit when the Fed abandoned reserve requirements in the spring of 2000. And so the old world dollar liquidity looked at the monetary base plus the foreign holdings of government security, U.S. government securities. But now what I do is I look at the Fed's holdings of government agencies plus the foreign central bank's holdings of governments and agencies. And on that basis, monetary policy from its inception, if you view the world financial system as an inverted financial structure, world dollar liquidity sits in the base. And when the Fed tightens it, it not only drains liquidity domestically, but it creates a shortage of dollars and drains liquidity from the rest. We are de facto the central bank of the world. If you look back at the price specie flow under the gold standard and the rules of the game of the gold standard, basically, in modern terms, the equivalent of gold in the gold standard days is world dollar liquidity. And that's in a contractionary mode. And the Fed has not yet reversed that. And so we have a lot of monetary restraint in the system. We're working down and erasing that monetary explosion from 2020 and 2021. But the likelihood is that the latest uptick in nominal, not day trend, and not detrended, is not an accurate reflection of the thrust of monetary policy.
Okay, so we have some signals that maybe are giving us some indicators are giving us false signals here at the moment. We have a monetary system
back into positive net national state. However, there are serious problems with the national income and product accounts, and particularly on the income side of the ledger. We saw what was a record gap in the 12 months ending March between the payroll employment data and the quarterly census of employment and wages. And then we had an even greater disparity in the 12 months ending June. Now, the QCEW is a survey of 12 million institutions. It's your full sample. The payroll data is based on a sample of 670,000 firms. And the rest are estimated off of that. And we had a record percentage deviation between the QCEW and the non-farm payroll. Already, some of the government statistical mills have stated reduced labor compensation, which in turn has reduced wage and salary income, which is reducing, will ultimately have the effect of reproducing gross domestic income. And so there are very significant reasons for believing that there are problems statistically with the national income and product accounts. So if you overstate income, then and spending is as good as they say, which is also questionable, then what it means is that the saving rate is even lower than is reported, and it fell sharply. The reporting fell very sharply, which means that consumers are in a real distressed mood. I saw a recent survey that 59% of our households have less than $1,000 of rainy day money. But another thing that tells me they're in distress is because the prime borrowers are paying more than 22% for their credit card loans. This economically is very unsound and tells me that they absolutely need to do that to get along. And in addition to that, the private reporters on the consumer's credit health indicate delinquencies rose again in the fourth quarter, and that the consumer loan write-offs were 50% above a year ago. Now, we don't have any alternative federal statistics that raise questions about the spending, but if the income is weaker, historically, it is more likely that the consumer spending numbers will ultimately be revised lower than higher. But even if that's not the case, the consumer is in a very challenged environment. And they've been spending in the hope that things will get better quickly, not based upon reasonable lending rates, nor based on the income that they're generating. One of the key numbers that I like to follow is the real weekly earnings of all hourly and salaried workers. In fact, I showed that chart in my keynote address. Mm-hmm. And over the last 16 quarters, we've declined at about a 1.5% annum rate. And you might recall, Adam, that I also said that real average weekly earnings, which covers 120 million of us, was an election predictor. And it's not an infallible election predictor, but it certainly was in November. Mm-hmm. And the election also gave us another useful indicator that most people wouldn't think about. But on election day, we get the most extensive polling that anyone does in the entire year. And that's the exit polls. The sample there is double or more than what the University of Michigan or the Conference Board do. More than 4,500 versus 17 or 1,800. And as people were leaving the polling booth in these exit polls, they were given 5 alternatives about how to characterize the economy. On the good side, they had good and very good. Then they had central range category, and then on the other side, they had bad and very bad. And those people leaving the polling booths said 70% said the economy was either bad or very bad. Mm-hmm. And so the folks on the ground are not feeling good. And there was a short rise in confidence after the election, big jump in December, but it's been entirely reversed in January. In fact, the Conference Board survey out today is actually below a year ago.
All right, so the Trump bump to confidence is gone already?
I think it has. I think it's a very, very fair statement. And why shouldn't people feel lousy? Because inflation is still high, it's coming down, but these basic necessity costs are hanging high. One of the features of the American economy is that we've been historically able to produce affordable cars and housing. They're not now. It's a residual of the accelerated money growth in 20 and 21. It's going to take time for that to work down. And so folks don't feel good about things.
Okay, so we have an economy that you think is, we'll say, going to weaken based upon the trajectories of the Trump administration's super pro-business, and they're getting in there, they're cleaning house, they're going to make the government much more efficient. They're going to bring in a lot of extra revenues from our foreign trading partners, and they're going to stimulate. We're going to drill, baby, drill. Why does that not make you optimistic, at least in the near term?
When it came time to take things to the next level, I knew that I had to make a website, and Wix was perfect for that.
The type of policies that the new administration are desiring to change really is a profound development. But their programs will be very beneficial to the U.S. over the short run, and not beneficial very beneficial over the long run, but not so over the short run. What we've had up until last week, I would characterize fiscal policy as a basically handout economy. In other words, the government was going to borrow and basically pass out cash.
All right, so basically giving handouts. That's what you mean by handout economy. It was giving handouts.
Giveaways. So when that type of policy, each economic activity over the short run is positively correlated. So when you're handing out more money, such as we were in 20 and 21, the economy got a huge boost. And of course it was financed by newly printed money coming from the Federal Reserve. But over the long term, the handout economy actually retards growth. And more so when it's financed by borrowed money.
Right. And can stoke inflation, which is what certainly we did there.
Absolutely. Because you give people spending power, but you don't increase the supply of consumable goods and services. So you create an imbalance between some demand and supply, which means you're going to get faster inflation, which apparently the prior administration didn't understand. Inflation harms everyone, but it harms the modest and moderate income households the most.
Mm-hmm.
Now, what the new administration is doing is they're shifting to a hands-up economy. Now, hands-up economies are very beneficial in the long run. They encourage people to work hard, work longer, be more productive. And this will be very beneficial if you go back and look at the Reagan tax cuts of the early 1980s. They were very slow to work. It took until the benefits were clearly took until 1987, 6 years.
Wow.
After the Reagan tax cut. But then the economy started clicking and rolling along. And what President Reagan did in the early 80s really worked all the way into the late 90s. It was a wonderful success story. President Reagan is given great credit for that. So right now, what the current administration is doing, it's disrupting the handout economy. And the expenditures, already we've seen freezes on some of the big programs of the last 4 years. The payments under the Inflation Reduction Act, big ticket items. I can't identify the benefits that we received. And also the Inflation Reduction Act, another big cost program. Those have also been frozen. And then a number of other things that have been done, as federal hiring, for example. As the Biden administration was leaving, they forgave a lot of college loans. Well, they had not finished processing of those loans, and the Trump administration has stopped that and notified the Supreme Court of what they were doing and why. And there will be some core challenges and so forth. No one knows, certainly not me, how this is all going to unfold. But when you end the handout economy, remember there's a positive correlation immediately. So you're going to get it. The economy will be restrained by those actions. And I suspect, I don't know, and this is just speculation, but what the new administration is doing, it's going to combine the expenditure cuts heavily in the Inflation Reduction Act, infrastructure bill, with the tax cuts. So the losses to the economy come first, and then the benefits come later. And it'll take time and patience. And whether the economy has that time, I don't know. Public gets awfully antsy. But the programs are definitely workable, but they're not workable in the short run.
Lacy, if I can interrupt just for a moment to have you add on to this and the rest of your answer. So I've asked questions of many of my guests in the recent past that you're kind of answering here, which is, will it require some short-term hits to growth?
There are two other levers that we haven't talked about. And I think the new administration is very well aware of it. They know that these policies are disruptive to the handout economy. But so to cushion the blow, the disruptive blow, there are two things that could greatly ameliorate that. And therefore give the economy some stimulus that would help fill the void while the tax cuts are passed and begin to work their impact on the economy. The first, and this is rejected by a lot of folks, but that makes it imperative that monetary policy become more stimulative. And based on my work, they're going in the opposite direction. The president has said the rates have to come down, which people, a lot of the pundits say, well, he can't force the Fed to do that. But I think that it will become increasingly apparent to the Federal Reserve that the economy is going to need help over the short run. And monetary policy, if the rates come down, well, that will ameliorate the blows of this disruption to the handout economy. The second thing that would be very helpful in ameliorating those negatives is bringing down of the oil price. The oil price commodity prices are about 15% of the cost of production economy-wide, and energy is about a half. So energy is more or less 7.5% of the aggregate cost function. So if the administration is able to drill, baby, drill, as the president says, then that could be helpful. This is a key component of the cost of business and the cost of living to our households, particularly the modest and moderate income households. So I think the administration is very well of that. We're very well of that, and therefore somehow, in spite of the fact that the Federal Reserve is a different entity than fiscal policy, both should want a better, stronger economy with lower inflation. And so there's going to have to be changes, or there will need to be changes in energy policy and interest rate policy. And then we can cushion the blow. And so it'll be interesting whether the Fed is going to remain behind the curve, or whether they're going to be anticipative of the gap that is being created by tearing down the old system and establishing a new system. I want to add one other thing. In Econ 101, students were taught the law of comparative advantage. In other words, the foundation for why you engage in international trade and why it can be beneficial, even if one country has the lowest absolute cost than its other partners. What is important here is the marginal cost. And a lot of countries will have the lowest marginal cost. And so therefore, under the Ricardian model, so well learned, hopefully, you get lower inflation and you get an increased standard of living. And people will say, well, tariffs do the opposite. They raise inflation and lower the standard of living. Well, now, because the students of Econ 101 remember the Ricardian law, they don't know that the Ricardian law doesn't apply to the current situation. And the reason it doesn't apply is because the assumption of the Ricardian model is that when partners engage in this agreement, that they all agree to play by the rules that allows the invisible hand to operate. If you allow the invisible hand to operate, which is a prerequisite of the Ricardian law, then you get efficient allocation of resources. But the Ricardian law is not operating, hasn't been operating for a long time, because China and others have been pursuing mercantilist policies. Mm-hmm. And so when countries, major players in the international scene, pursue mercantilism, what you get is a malallocation of the world's resources. In other words, the world's distribution of goods and service production is tilted toward the bad players. Well, if the tariffs are enacted, they will certainly raise the items, at least temporarily, on the goods that are being tariffed. But what do we learn? Number one, when tariffs are announced, immediately the dollar strengthens. The foreign exchange markets are an equilibrating factor to tariffs. But more importantly, if you are able to change the behavior of the mercantilist, what you're doing is you're moving the world back to the operation of Adam Smith's invisible hand. And you're going to get a better distribution, more efficient production and allocation of the world's resources, and the inflation rate will fall. And people said of the tariffs in the president's first term that it would be highly inflationary. But they didn't take into account the fact that the dollar would rise, which it did. At the same time, drill baby drill policies were being undertaken, totally outside the trade arena, which was bringing down costs. And in addition to the fact that the tariffs resulted in a higher dollar, it also improved the efficiency of the world's distribution and production network, which you give the world higher productivity, which results in lower costs and a higher standard of living. So the tariffs are an effort to produce a better economy. And by the way, it's not just the United States that's been harmed by the mercantilist policies. The mercantilist policies of those countries that do that have hurt Germany and Canada and Australia, the UK, and so by trying to return the world to the invisible hand, the program will not only be successful for us, but it will be successful for our major trading partners.
Okay. So what I hear from you,
I mean, theory there, but there's a lot of misinformation out there on how this works.
well, I think it's going to be important to get, seasoned voice of
Term of the president, they raised tariffs, but the inflation rate went down and the economy performed very well.
Right.
In fact, one of the political forecasting errors of your real average hourly earnings, your real average weekly earnings of hourly and salary employees, was the election of 2020. The former president had a good record that way. Maybe he did other things wrong, and he did, but the fact of the matter is that he had a successful political record to run on. The pandemic and other things sidetracked his message, but I think what you would have to say is that based upon the first term, I think we have to give them some credit for understanding the way in which the world works, really works.
well, that's encouraging, and I'm kind of detecting, sort of summarizing this, Lacy, I detect, somewhat of an optimism from you about these policies, if they're able to be enacted, that they will get us to a better state than we are right now. And some of the things that you said would help kind of cushion the blow of the disruption, like more stimulative monetary policy and a reduced oil price. Some of these deflationary forces you've been warning about should probably help on that end, because it'll give the Fed air cover to be more stimulative, and if the economy is slowing, that by itself will reduce oil demand, in addition to the drill baby drill and Trump, putting pressure on OPEC to bring prices down. So maybe that's quote unquote good news. I guess my question for you.
Very well said, Adam.
Well, thank you.
Never said than I did it.
No, I look, when you speak, I try to take good notes, my friend. But here's my question for today's viewers, right? Which is, okay, it's nice to hear Lacy sounding a more optimistic tune about the mid to longer term,
Yeah.
but we got to get from here to there.
That's right.
So with this disruption, with this turning off of the handout economy, and with the deflationary concerns that you mentioned beforehand, Do you expect us to be able to finesse this transition to the better tomorrow where it's really not that bad, or do you expect some rough sledding?
We have to wait and see how it plays out. But I think they have a better than 50-50 chance if they combine the extension of the tax cuts and the new tax cuts with the expenditure offsets. And what I'm seeing so far is a very, very strong effort to bring the spending down so the tax cuts can be more easily and soundly financed. But this is a long, difficult process. There are a lot of unknowns, there's going to be the main beneficiaries and their political allies that support the handout economy are going to resist all the way, and we don't know how much of it can be accomplished. We don't know how the Federal Reserve and the new administration are going to work together. And so the process is going to pursue a difficult path to know, and we'll have to make changes as the new information comes in. But there is a pathway there to a better longer-term outlook.
Better longer-term. All right, I'm going to ask my question one more time, which is, when I heard you start here, Lacy, I was thinking, oh, okay, so Lacy's ringing a warning bell saying everybody's focused on sticky inflation and assuming that the economy is going to do great for the rest of the year. But Lacy's ringing a warning bell saying, hey, folks, you're looking at the wrong thing. Deflation's in the driver's seat. We got to start worrying about slowing economic growth, rising unemployment, that type of stuff. So as you look to out the next 12 months-ish or say, are you more nervous about where things are headed? We haven't even talked about kind of the high degrees of valuation in today's equity market. But are you more nervous about where the economy could go and where markets could go, or are you more optimistic that, hey, now that we've got this new administration in the driver's seat, yes, these deflationary forces are going to matter, but they're already starting to try to figure out how to offset them?
I am more optimistic for the longer run, but
next 12 months.
But I would like
push on that.
Stay with my original characterization. There is a pathway there. Before the change of regimes, there was no pathway there.
Yeah.
So we have to be more optimistic.
Okay. And I'm sorry to ask this one last time. I get you're more optimistic if we're looking at a 3 to 5 year time frame. If you're looking out to the end of 2025, what do you think wins out? Some of these disruptive deflationary forces, or do you think it'll be, maybe a wash?
I think that the risks over the near term are to the downside in terms of the economy. I think inflation is going to surprise everyone, and whether the foundation is laid for recovery in 2026 is going to be up in the air until we see how the new legislation is put together and the time period over which the tax cuts will take effect, and whether the reduction in the non-productive spending is in fact phased out, as appears to be the position at the present. We're just going to have to be prepared to make adjustments as we go here. One other thing that I might add here is we've not seen a shift like this since Reagan.
Since Reagan, yeah.
And one thing that was very different, that the economy was coming off a horrific recession, and inflation was running rampant. And so, although his policies couldn't kick the economy into high gear, you were in such a hole as you started inching out of it. People were willing to take this as enough of a sign that the country was on the right track. And the way in which the public responds to things is really an unknowable event. We will have to monitor it. But Trump's at a disadvantage to Reagan because Reagan came in when everything was in despicable condition. And I think that right now there is an illusion that things are pretty good. I disagree with that. And I think we're going to have to go down first, and we're not going to reach the cyclical trough until we're well into the year. And whether the public can live with that, I think that it will help a great deal, if the interest rates and the oil prices come down. And I think that the tariffs, even though no one else believes this, I believe the tariffs will actually produce better economic results. So we can get there, but it's going to be challenges. And obviously, we're not unified politically on that. And the political winds can shift very quickly.
Mm-hmm.
And so I'm not a political seer. And we're going to have to be prepared to go with the flow.
Okay, and forgive me for dating like that, but you went exactly where I needed you to go, which is, just clarifying your outlook here in the near term of this transition. And the reason why I did that, Lacy, is I know you, like me, care about the regular person and the people whose jobs might be
The
displaced.
forgotten American.
What do you call it?
If we base policies on the forgotten American, we would be better off. And, I continue to hear that why not let the inflation rise? But when people say that, it tells me that they know absolutely nothing about economics. Inflation is very harmful to the vast majority of our people. Maybe 10 or 15% of our society can benefit from high inflation. The rest cannot. In fact, their lives are made wretched.
Exactly, my friend, which is again why I wanted to clarify this. So for folks that might have been possibly getting an all-clear message. Yeah, for folks that might have been getting an all-clear message, I think, forgive me if I put the wrong words in your mouth, you would be saying to the modest and moderate households, which are the bottom 90%, hey, be cautious about what may happen with your job going forward in the next year as these deflationary forces win out. Some of these long lags that have been long delayed maybe start, finally arriving here. Be a bit cautious about what might happen with the markets from here, given how richly valued they are, given the trends you see coming in the near term. Hopefully in a year, 2 years plus, we're riding the upside of some of these things we've talked about, but you don't want people to sort of sleepwalk into the starting period of Band-Aid ripping off.
That's an excellent point, and I might make one other point about now versus when Reagan. At that point in time, stock market valuations were in the bottom of the barrel. Here, the stock market valuations are very, very high. And there's a presumption that the stock market is invulnerable on the downside. So fiscal policy took a long time. In the early 80s, it worked, set the economy on an excellent path for a long time. And but you were at cyclical lows in inflation, the stock market, and the economy. And so when you began to see the first green shoots, we had improvement. And people began to feel it even though business conditions were not good, and they didn't really become good until the last 2 years of the Reagan administration. And so if we're more impatient now than we were then, we may not have the time to fix the problems.
Well, let's hope we do. So, all right, Lacy, look, we're going to have a lot more data to react to in terms of where interest rates are headed, where oil prices are headed, whether these market valuations are sustainable or defensible or not, in a couple of months at the spring conference. Folks, if you've enjoyed listening to Lacy's just immense seasoned expertise here, trust me, this is just a fraction of what you're going to get versus the conference and going through all the charts and data that Lacy lays out at it. Again, as a reminder, to sign up for that conference, make sure you get to hear Lacy's presentation. Go to thoughtfulmoney.com/conference. Every year after Lacy kicks this thing off, I see in the live chat there at the conference people saying, "Oh my gosh, that was already worth the price of admission," right? And he's just the first speaker we have for the day. We've got a number of great speakers. Just to rattle off a couple of quick names real quickly. We've got both Luke Roman and Brent Johnson. We've got Michael Howell, who will be giving a liquidity update. Darius Dale will be giving us the latest update on his model. From an international standpoint, we'll have Louis Vincent Gov. We'll have Melody Wright on housing. We'll have Stephen Bavaria on income-based investing. We have a number of other big names that I am in the process of locking down here, folks. So you're going to get updates on those soon. But again, Lacy is the hero that kicks this thing off for us. Lacy, beyond watching you,
You got a great lineup there. Congratulations.
Thank you. And again, thank you. And that's just the start. I say this every year.
People are really going to learn something. They really are.
Thank you. I think
I'm looking forward myself.
I think they really will. And there's some names.
And I say that even
really
though quite a few of them are going to vehemently disagree with me.
But you know, if they do, that's great. You know, that's how we make a market, right? We look at different approaches. Yeah. All right. Well, look, Lacy, it's just been fantastic. I can't thank you enough. By the way, folks, another thing about the Substack, if you are a premium subscriber to our Substack, you get an additional $50 off of the ticket price at the conference. So I mentioned we're making it available for our lowest early bird discount price. You'll get an additional $50 off of that if you're a premium Substack subscriber. Lacy, can't wait to see you at the conference. Folks, please tell Lacy how much you enjoyed this by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. Always a pleasure, Lacy. Thank you so much. Really look forward to seeing you.
I have a great relationship. I have a lot of great relationships, but you're right up there at the top. You're a great fellow. I'm just so glad I'm honored to keynote your conference again.
That is so kind, Lacy. I am honored too. And again, I consider you one of my top mentors, just a great friend, and I feel this is a mutual relationship. But I feel like I get about 99% of the benefit of it.
No, I wouldn't say so. Not much.
Well, thank you, my friend. Really look forward to seeing you in March.
Okay, fantastic.
All right. Everyone else, thanks so much for watching.
Turn your pastime into your full-time, your personal style into your signature brand. Do it yourself on Wix.
Execute your vision with confidence. Defy and conquer with Kamala Joe.
All right, guys. Thanks for letting me share.